Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for July 25th of 2022. Please see our disclaimer for important information. Here in our high frequency data, we do see positive trends over the last week in some of the categories that we've been paying very close attention to. Open table, restaurant industry, TSA checkpoint, open table restaurant notably is down fairly significantly over the month, and I think it reflects some of the demand destruction that we've seen due to high prices, and also a general feeling amidst this malaise of inflation that people are not eating out as much. But versus 2009, we're actually not too far off the mark. You can see in that third to the right column that most of these categories are still trailing the 2019 bellwethers, I guess, if you will. But really the only categories that we do see are really the more lumpy ones. We've got box office receipts. There's some ones that are not published on this that have been a little bit weak over the last couple weeks, I should say. But you look at rail car traffic is up rather significantly, but that's been a pretty volatile statistic. So it's been a little bit weaker over the month. Steel production a little bit weaker as well. So some puts and takes. Overall, not terrible data, certainly indicative of some demand issues, but with regard to the supply of motor gasoline, we've had actually a fairly strong decrease in gasoline prices, which we'll talk about a little bit later, that have helped to kind of allay some of the concerns there somewhat. Here's the Philly Fed data that we got last week, and it was, as expected, fairly weak. So you can see here new orders and expected new orders both trailing in the contraction territory. And I think it's probably notable here to presume that we are on the precipice of a manufacturing recession after the tremendous goods demand that we saw in 2020 and into 2021. Again, this is something I've been talking about for a while now, but this data clearly is giving us that sense now that manufacturing recession is on the near-term horizon. Here's Philly Fed unfilled orders as well as delivery time. So if there is something good to be said about a slowdown, it is the fact that supply chain choke points have not been totally cured, but the demand destruction that we've seen in the economy has certainly cleared up a lot of the issues here. Unfilled orders are now trending negative. So basically that means that orders are can be filled really in kind of a real-time basis, that we don't have this backlog issue that we had for many months, just on balance. And again, this is for the Philadelphia Fed region. But it is very symptomatic of what's going on across the country. You see delivery times also trending in a favorable light here. Again, supply chain, time to market, those types of things are clearly getting better. Here's prices paid and prices received. So we see the impact of some of the demand issues in the Philadelphia Fed region. So they're still high in both cases, but they've come off their peak. So certainly prices paid, amidst this massive amount of inflation that we've got right now, it's a good sign to see this. Again, this is manufacturing data. So these are cost inputs that are being realized on the part of manufacturers, and then prices received really reflects the ability for these manufacturers to pass these price increases on through to the customer. And you see, and basically they're not really doing that. Prices received are really kind of tracking the input price right now. So margins, at least from a manufacturer's standpoint, are holding roughly steady. This would tend to suggest, or tend to dovetail, I should say, this manufacturing recession or a contraction that I'll call it. It also, tends to kind of lead a little bit overall inflation. So if there's a positive offset to the potential for a manufacturing recession. It certainly is that inflation appears to be on the precipice of coming down. Here's the Conference Board U.S. leading economic indicator number, or the index, if you will, and you see it had a fairly strong drop. It was actually a little bit worse than expected. You can see from a linear standpoint, it ended up about -0.8% for the month, and this is month-over-month data, and so you can see the kind of the gyrations on the left-hand side. But it is definitely tracking at a post-pandemic shutdown low, and so we are concerned about that. The contributors to that are on the right-hand side, and you can see the average work week, ISM, Institute for Supply Management, new orders negative. Consumer expectations were a real anchor for LEI this month, and those were down fairly sharply. And so the consumer, and think of it this way, it's kind of like that pendulum that never rests in the middle, and oftentimes the consumer expectations swing wildly from one side to the next. And when the market's good and incomes are high, the consumer expectations tend to be super high. And when you have an environment now, when you've got a lot of people talking about inflation, slowdown, recession, etc., these expectations tend to swing wildly in the opposite direction. But we did have an offset here in the interest rate spread data. So we did, with interest rates having moved down, we'll talk about that in a second. Goods orders pretty flat. Credit index really a slight contributor, cap goods, and then you see stock prices, jobless claims, both dragging the index down a little bit. Here we have inflation expectations, and this is the TIPS 5-year break-even. TIPS stands for Treasury Inflation Protected Securities, and it's basically a sleeve of the Treasury market. So basically these are created, and it strips out basically the coupon and gets you to an inflation adjusted number. So you play this if you want to protect your fixed income investments against inflation. So what we see here is the 5-year break even has come down considerably. It continues to come down. This is not certainly the first time you've seen this chart, but it's come down from 3.76 down to 2.48. And again, this is looking out 5 years. And Fidelity here loves to put this on top of the container rate. These are shipping costs. You've got the container prices for Shanghai to New York and Shanghai to LA, and you can see that this inflation expectation actually lags the rollover in this data. You can see here that those numbers were coming down even at the beginning of last year. But just again, to drive the point home that inflation expectations have come down pretty dramatically here as of late. Here's a quick look at U.S. rates. And so, and this is another chart which I thought was pretty interesting, because what you're seeing here is you've got essentially short-term rates that are still moving higher. In the pink and in the orange, you've got basically 3-month to 12-month U.S. rates moving higher. At the same time, like we just saw in the 5-year tips, you've got 10-year yields that are coming down. And so that's the expectations that being priced into the market that we are going to have a slowdown. And so you see that divergence very, very acutely on the right-hand side of this chart. And what it really tells us is that we may have seen the peak in rates for the cycle. So, those that are getting carried away with the thought of, continuously increasing yields now that this paradigm seems to have shifted and might be a little off base, at least for the time being here. Here we see the commodity index, price returns. You can see crude oil is still a high, but we've seen a lot of transition over the last couple of months in some of the other areas, certainly in agricultural commodities and even in industrial metals. So even though they may remain high. Some have come down in a fairly meaningful way in a relatively short period of time. Housing starts. We see housing starts are down 6% year over year. Not terribly surprising, although with interest rates kind of holding in there, we have housing affordability that remains pretty challenged. And we've shown you a lot of charts on that over the last few months, and really not much has changed there. But housing starts here again represents a sliver of the entire market. We also are very careful not to minimize the value of existing home sales. And we do know that mortgage applications are flagging a bit here in this environment, and certainly refis have gone away. But we do see housing starts and builder optimism just come off its high just for a little bit. Here's U.S. existing home sales. And this is not the sales number. This is actually the median price, and so you can see why we've had a little bit of froth being taken off the market. I would say in many respects, many major markets are kind of normalizing now, and that just means that things aren't going, basically coming off the market literally as soon as they go on at $100,000 over asking price. So we see houses stay on the market a little bit longer. We see price adjustments coming down. I think we showed you a chart last week where we've had a very uncanny number of rate decreases for existing home sale listings. And here you can see median sales price continues to trend higher. And so this has really put a crimp on affordability, and it's caused some buyers to pull out of contracts, and it's caused this readjustment, if you will, in the real estate, the residential real estate market. Well, we're going to transition a little bit to earnings for a second here, and you've seen this very busy chart before. The black line represents the S&P 500, and the divergence between this light blue and this purple here, represents kind of the gyrations of basically earnings growth and change in the price earnings multiple. And as we've been talking about this, I mean, the PE ratios have come down quite a bit. At their trough, I guess they were down 35%. Now they're down around 30%. And we've also entered this kind of weird period where you've got contracting multiples, but you have earnings growth that's beginning to slow. And I think estimates looking out a year ahead are still looking for about 10% growth here. But you can see, that this change in earnings growth has led to the market rolling over. And so the question here remains, are we close to a bottom in terms of valuation? I would and have argued, yes, I think we have. Now the question is, how far do earnings fall? And they've already come down a little bit. Now the question is, how far do they come down from here? And I think that will eventually tell us where our bottom is in the market. Now, in a typical, call it bear market, we're down, our peak to trough to date has been about 30%. Now, in some cases where you have that bear market associated with a recession, that drawdown could be as much as 50%. And so to get to 50%, obviously the math has to work out that you have to have a severe degradation of earnings. And as we've seen, earnings coming out of the S&P 500 have actually been really resilient coming out of recessions. And so, if we do have, for some reason, and I don't think it's as likely because corporations are still paying lots of dividends, they're generating they're doing a lot of stock repurchase activity. Cash flow is not a problem. Even though some banks have locked in low interest rate lines of credit just to kind of give them some extra seed corn, balance sheets are really not in bad shape for the larger publicly traded firms, and so they could easily weather the storm and better than small companies can. And so I do think the earnings number, while it is apt to degrade, it's not apt to drop by nearly as much as some people expect. So I don't not sure that we see that continuous drop that folks are looking for. And I think that's only the case if we see, a major break in economic conditions from where we are now. Here's global monetary policy, and you can see the dollar index in the black line. We've been talking about the dollar for some time, and you've seen the back and forth here. If you look over on the right-hand side of this, we've had fairly strong peaks and valleys over the last, call it 8 years. And this year is absolutely no exception to this trend that we've seen. And while I guess the magnitude of the rate of increase in the value of the dollar has been pretty dramatic, it's not unprecedented. And so, and you can see down in those boxes down below, Fidelity has gone to great lengths to show us where the policy rates are on an inflation adjusted basis, and also adjusted for a quantitative easing here. You can see the Fed is now raising rates at the same time that you have other jurisdictions going a bit more slowly, and we did get a fairly strong signal coming out of ECB last week, which is actually not anticipated, but the Fed is obviously raising rates at a faster pace than the rest of the world is, and as a result, our dollar is increasing. Emerging markets. We haven't said a whole lot about emerging markets other than the fact that we're not really invested in them right now. And you can see the transition even dating back from 2020. A lot of this has to do with the strength of the dollar, but not all of it. You see the pandemic having a fairly strong impact on emerging markets and access to product. We've seen in some cases commodities, which emerging markets tend to export more of, being a net benefit, but in terms of the market index, we haven't seen a lot of profitability coming out of the EM, and the outlook over the long haul is probably pretty decent. Valuations are fairly low for EM markets, but the financial conditions index, at least right now, is not conducive for strength in that particular market. So the B of A Merrill Lynch Global Investment Strategy shows us here that that a lot of the private client equity holdings, or at least just say private client equity holdings as a percent of assets, still remains pretty high. And you see this trend line going back to 2005, and it's obviously been much lower for the balance of that time, and particularly over go back to 2013. I mean, we've only seen one other period where we've been this high, and that was back in 2015, in fact. But we have come off our peak, but we're still pretty high. So this is kind of goes to show you that while there is trepidation out there, obviously concern about inflation, obviously concern about equity valuations and equity earnings growth and things like that, that by and large private client portfolios are still heavily skewed towards equities. Now here's a pretty interesting chart, investor sentiment. Now we have seen here that in the bottom, I'll point to first is like the Investors Intelligence Survey of percentage of bulls and bears. And right now we've got about 40% in the bear category, and that's up. And typically you see a lot more bulls than bears over long periods of time. And the last time we saw really an inflection of the magnitude that we have now, we did have a little bit of hiccup in 2015 into 2016, but you've got to go back to the global financial crisis to see something to the tune that we're looking at right now. And so while private clients still hold a lot of equities, the investor sentiment overall is actually pretty bearish. And so and you can see how that dovetails with the upper part of this chart, which represents the S&P 500's drawdown from the 12-month high, and how you can see where the volatility in the Investors Intelligence Survey tends to correspond with those drops. And so right now we've seen that aggregate drop from the peak here, representing a kind of a pretty strong dovetail to the bearish sentiment moving higher. We talked about gasoline prices off 63 cents from their June high here, and the national average as of the 23rd was about $4.38. You can see in the blue here represent the Gulf states. For the most part, again, closer to refineries, so you tend to see, lower prices than if you're farther away from the refining areas, I should say. But you can see the different areas of the country, and obviously the West Coast and the whole Pacific, I'll call it Pacific time zone, if you will, is struggling with pretty high prices right now. And but it has come off its peak. You see the little inset chart. This is the RBOB futures for gasoline. Basically, it's off about 63 cents. Auto delinquencies. Now, we've talked about credit quality being relatively high. We hadn't seen a lot of tectonic shift. We're getting some data now. This is from Ally, I guess it used to be called GE Capital, rebranded here, but several years ago. But retail auto delinquencies beginning to pick up here. You've got in that, and you basically, you see the delinquencies for the second quarter as have now been reported, representing an uptick, certainly over what we've seen and over quite a number of quarters. Investment grade funds saw significant outflows. So a little bit of a mosaic here. So we've seen private client equity portfolios that remain fairly heavily exposed to equities. Here we've got investment grade fixed income funds that are seeing a lot of outflows. So this is pretty interesting. And I will argue, and then we have a chart, actually maybe one or two charts coming up next to kind of show you how it really is an odd time for you to have significant outflows out of bond funds, because I said for some time that I thought the bond market was probably a little better position than the equity market right now. But clearly, while you have a consistent equity investment, you have significant outflows from fixed income here. And here's lower inflation expectations rolling over and showing you, basically giving you a roadmap to to lower rates. And we saw this in the Fidelity chart some slides ago. Where rate expectations are really beginning to roll over. And I said then, and I was referring to these charts, that those people at their peril choose to exit the fixed income markets at a time where we really do think, with all of the inflation expectations moving lower and influencing how real rates are beginning to trend, that you might be better suited being in, and perhaps even adding some duration to the portfolio in light of this. So, but this chart shows us we have net percentage expecting higher global consumer price index, and so this is a fund manager survey. So again, not consumers, but it's intelligent investors, if you will. And so the consensus now is that we're going to see lower inflation, and that should begin to correlate, as it is in that light blue line, to the net percentage expecting higher short-term rates, and that number's moving over. Again, this whole feeling that maybe we've seen kind of an interim peak, at least in interest rates, with those rates apt to move lower. And if they are lower, then you certainly want to benefit, because as rates move lower, prices go higher. And more to that, we show spreads. On the left-hand side, we've got the Treasury spread between the 2-year Treasury and the 10-year Treasury. On the right-hand side, we've got the spread between the 3-month Treasury and the 10-year. And you can see in both cases, we've seen a consistent and pronounced drop over a fairly short period of time. Now, one difference here, I mean, the 10-year to 3-month is driven a lot more by short-term interest rate movements than the 2-year is. The 2-year, 2 to 10, I'll call it, is negative and moving a little bit lower. What does that mean? That just means that our yield curve is inverted, that 2-year yields are higher than 10-year Treasury yields by the tune of about 0.2% right now. And so, again, a fairly decent predictor of inflation, or of recession, is that inverted yield curve. And so, again, we haven't really seen that a lot. We actually ironically saw it back in 2019. And back then, we were beginning to talk, perhaps in the latter part of that year, the market being a little frothy and maybe apt to roll over, and the chance of a potential recession was moving higher. And then, lo and behold, we had the pandemic, which kind of blew all those arguments out of the water, and in fact did lead to a recession. But you can see where the recovery happened. You could see the spreads in both the 3 to 10 and the 2 to 10 moved higher, and then now they're coming back down with this expectation of a slowdown. We've been talking a little bit in the prior slides about some of the commodity price baskets coming down. Here is the grains sub-index. When you think about grains, you've got soy, corn, wheat. You've got all of that in this basket here, and these prices have come down rather dramatically. Here we've got gold. I realize maybe a little tough to look at, but where gold sits right now, it's forming the same pattern. In the upper left, you can see a very similar pattern that we saw in 2013. You can see what happened after that gold, in fact, went down, and you can see the gyrations over more or less the last 10 years. So we have seen gold come off its high, and it looks like kind of a head, maybe not quite a head, but two-shoulder pattern, with the potential of it rolling over. And you've got, in terms of positioning, which is a lower chart, you do see net long investors decreasing gold. People are kind of paring their gold positions at this time. We've got crude oil here, which has undergone a pretty dramatic convergence here around the upper $95 to $100 barrel range. And, a big question is what happens from here? And obviously we've seen a little bit of demand destruction, but prices coming in have kind of tempered that. And we saw in the high frequency data that we actually, have had a little bit of, well, let's just call it that the demand for gasoline is not terrible right now, as we had feared it would be when we were talking about this subject about 3 to 4 weeks ago. So the big question is, where does this breakout happen for oil? Here's natural gas, which is actually moving the opposite way from oil. There's different reasons for that. Obviously, distillates from crude oil make gasoline, kerosene, so on and so forth. Natural gas, we know. We had some problems with an LNG export terminal explosion, which is preventing product from being, liquefied and put on ships and sent to Europe. But natural gas is trading, at least the volumes and the supply is trading within a 5-year average. And we just see here prices here have kind of rebounded from earlier this month, and we'll obviously be very curious to see where these go as well. Something I've been reading a lot about lately is this whole transition to renewable energy at a time where we have these supply problems globally with Russia curbing exports of energy to areas not friendly to it. Meanwhile, shipping product at a discount to India and China. But the criticism has been over these last several months in light of this that we've transitioned far too quickly to renewable energy. So in this chart, again, not making any kind of a political statement, but it is clear here that both on solar and wind, that the amount of electrical production that's derived by this is moving higher. Now, still, both of these areas represent a minority of total energy production, but they are increasing here. And you can see the 5-year range of basically grid contribution from these two components. And we're obviously at the high, particularly for wind power. And it'll be very interesting to see if we have new developments that are maybe offshore within our territorial waters. New development in wind that could help increase that over time. But the bottom line is, without waxing too political, is the transition to renewables is something that will likely happen, but it's going to take a long time. And I think the ambition to get to net zero, even by 2050, is probably a far bet. That's 30 years from now. But again, we've got emerging markets. We have economy, developing world that doesn't have anything to do with renewables right now. And of course, the world's largest economy, which is the U.S., we're struggling with that. And, we're not going to get there fast enough. And it leaves us at some exposure on our national security front when we don't have enough power to power our grid and we've got a growing population. Well, our last couple slides here are really more from an educational standpoint. I just love this chart to show this, and this is actually updated through December of last year. And so it just shows you, the impact of missing the days in the market. If you literally, for those who have, have taken money out of the market, said I have had enough, as opposed to just staying with a standard growth portfolio. And but this is actually represents equity returns. And so if you missed the best 10 days, you can see here your return would have gone on a $100,000 initial investment. Dating back 10 years, your returns would have gone from about $460,000 to $260,000. And if you miss the best 20 days and 30 days, you see it goes down from there. And if you stayed out for basically almost 2 months of the best performing market days, you would have actually lost money over the last 10 years. And so, what I always try to educate investors about is that if you have a policy, stick with it. And I know it's hard after this first half where bonds also went down 10%. Stocks went down 20%. The average 60% equity, 40% fixed income portfolio was down 16%. That's pretty painful, and I get that. So, but just use this chart as a guide to kind of help you understand that if you take your chips off the table and go to cash, and a lot of books are written on how to buy the market, but very few are written on how to sell and get back in. And this is a chart that emphasizes why you don't want to do that. And more along those same lines, this is just kind of a capitulation case study here. So, if you have in 2020, you'd hit the pandemic, and there were a couple of folks that we work with that said at that time, I can't take it, I want to move the cash. And so again, not too many books are written on how to sell the market and how to get back in afterwards. And this chart shows you that if you had capitulated at the low point of the market, which may be a little bit of an extreme example, but the market low was on March 23rd of 2020, and you had waited about 3 months to get back in, your total return would have gone on a $100 investment from 133 to 107. So you clearly would have sacrificed return. But if you'd held out for the rest of that year, your investment would have gone down to, from 133 to 94. So all the more reason to not pull yourself out of the market, and maybe adjust your allocation, maybe raise a little bit of cash, but don't exit the market. And that's the main lesson from this. And so, and again, there's no rule of thumb that is going to tell you when to get back in. And oftentimes, if you do wait, you're going to be waiting for something that, when you realize it, it will have already passed you, and the market will already be moving higher. And to that previous chart, you'll be giving up a lot of gains. Well, that's all we have this week. Hope you've enjoyed this chart pack. Hope you have a wonderful week. Stay cool in the shade, and we'll talk to you again very soon. Thank you. Bye-bye.